Hi everyone, welcome back to my channel. This is the FI Journeyman YouTube channel, and in this video I'm gonna show you guys how I use the options wheeling strategy to generate additional income and also hedge my portfolio. This is actually a re-recording of the previous video that I did. There were some issues with the audio, so I decided to do a re-record and also to capture some of the key points that I covered in the previous video. Without further ado, let's dive straight into it. So, for options strategy, when it comes to option wheeling, I'm just mainly looking at two trades. So, namely the cash secured puts and also the covered calls. So, I like to look for stocks on high IV, and Nvidia is one of my favorite stocks to trade option contracts on it. So, let's take Nvidia for an example. Today is the 13th of July, so market is closed on a Sunday. However, based on Nvidia's last price, which is 164.92 at close on the 11th of July, we can take a look at the call and put straddle. So when it comes to option trading, we have to look at the option chain. So right now, what we have here is the call option on the left side and the puts option on the right side. So let's scroll down to the current price of Nvidia, which is around 164.9. That is where the strike price of Nvidia is 164.9. Okay, so it's somewhere here in the middle. So you can see over here, this is what we are looking for. So when it comes to puts, remember it's on the right side and then calls is on the left side. So typically when it comes to the option wheeling strategy, I like to sell puts on Nvidia first. So for example, I sell a put of Nvidia at 160 strike price, meaning to say that I sell the insurance. You can think of a put option as an insurance. I sell the insurance to other buyers that would like to buy insurance for their Nvidia shares at $160, meaning to say that I have an obligation to buy Nvidia shares at $160 should the share price of Nvidia drop to 160 and below. So this is essentially a covered or rather a cash secured put option. I'm selling a put option to option buyers to hedge their portfolio against Nvidia dropping below $160. So for me, I will come in to buy Nvidia shares at $160, and in return for that, I get compensated with the option premium, which is $1.1, $1.10 is what I get for selling the insurance to the option buyers. So each contract of options has 100 shares. So each option contract consists of 100 shares. So the capital outlay that I need to have in my brokerage account is 160 times 100, which is $16,000. I need to have $16,000 in my brokerage account to stand by in case I get assigned 100 shares of Nvidia at $160. All right. So in return, the premium that I get, which is $1.10, will be multiplied by a factor of 100 as well. So I'll be getting $110 for this, for selling in a cash secured put on Nvidia. By the way, just now I forgot to mention, when we look at the options strategy, we have many dates. So for this particular chart, this particular option chain that we're looking at, it's for 1 week. Okay, so it expires on 18 July. If you want to have 2 weeks, then it will be 25th July, 1st August, so on and so forth. So I tend to like to trade options with 1 week expiry because I can recycle my capital faster and also I can have more liquidity. Okay, back to the option strategy. So if let's say for some reason Nvidia drops to below $160 and I get assigned to buy 100 shares of Nvidia at $160, the next move that I'll do is that I'll sell a covered call. So for example, the share price of Nvidia right now is back to 164. and I'm going to sell a covered call on Nvidia. So right now I have 100 shares of Nvidia stock. I have to sell it. Let's say I choose the strike price at $170. So this is the option premium that I have. So meaning to say that I'm obligated to sell my Nvidia shares at $170 should the share price of Nvidia rise to 117 and above. So I have to sell it at 170. This is the covered call. And in return for that, I will be paid 97 cents. And as mentioned previously as well, each option contract consists of 100 shares. So 97 cents times 100, that will be $97 of pure profits that I will get in my brokerage account. So all this is will be expiring at 18 July, meaning to say that 1 week from now, the options contract will expire. So once expire, my capital and my shares will be free up again for me to do another option trade. So this is what I like to do, weekly options. Of course, some people will say, okay, I want more premiums. So instead of looking at weekly options, they want to look at monthly option income. That is possible as well. So let's take a look at 15 August expiry. Okay, so this is the option chain for 15 August expiry. And I'll scroll down to the strike price, and you can see that the premiums for the Nvidia options will be a lot higher. So just now I'm selling cash secured put for $160. I'm getting $1.10. Over here I'm getting $4.95. So if you multiply by 100 shares per contract, that will be $500 that you can earn in that 1 month. Okay, because from now till 15 August is about 1 month's time. So you can earn $500 every month by selling a cash secured put. You will still need to have the capital needed for the cash secure put, which is $160 times 100. That is $16,000 that you will need in your brokerage cash account on standby in case you get assigned. Conversely, if I were to sell a call option at $170, I'll be paid $5.27 times 100 shares in an option contract. That would be $527 straight into my brokerage account as a premium if let's say I'm selling a covered call for Nvidia at 170. Okay, in order to sell a cash secured put, you will need to have enough cash in your brokerage account. And in order to sell covered calls, you will need to have enough shares. In this case, I will need to have 100 shares of Nvidia in my brokerage account as the collateral for selling covered calls. Okay, I hope you understand what I'm trying to explain over here. And for the next portion of the video, I'm going to show you guys some of the profits that I have from selling weekly options. And I've been tracking for the profits every month. So I'm going to show you for the month of May, I sold an Nvidia call. One of it was assigned. Okay, so strike price at 133. So I sold 100 shares of Nvidia at 133. It was assigned. The other one, I sold a covered call at strike of 142. It wasn't assigned, it was expired, worthless, so I get to keep the premiums for free. So these are the premiums that I'm getting for the option trades. All right. Yeah, so basically for the month of May, I'm just selling all Nvidia calls because I do have quite a lot of Nvidia shares at that point in time. Right now, I've sold almost all my Nvidia shares already. So if you calculate in total all the profits that I get for May just by selling Nvidia call options, covered call options, I'm getting $159 per week, which isn't too shabby. How about the month of June? Okay, I'm continuing to sell the call. I'm continuing to sell the Nvidia covered call because the previous calls were all expired. So I still have Nvidia shares. I still have enough Nvidia shares to sell the calls. And I also sell some puts for IBIT. IBIT means the IBIT ETF. Basically, it contains Bitcoin ETF by BlackRock, and I'm selling cash secured puts on that as well. So you can see all these are IBIT puts, a few Nvidia calls, and also a BitX put. BitX is a 2x leverage Bitcoin play that will have more option in premium income. So if I would add up all the earnings from the option premiums, what I'm getting is actually $400 for the month of June, which is very, very good. So in total, for these 2 months, I've gained $555 USD, and that is on a capital of around 60 to 80,000. That is a working capital that you'll be required to pull off this weekly option trades to generate this kind of income from options. So to me, as I mentioned, in my portfolio strategy, I'm using options to turbocharge my returns and also at the same time hedging some of the volatility in my portfolio. So I find it really useful using the options, weekly options income strategy. Specifically, I'm using a wheeling strategy, selling cash account puts and also covered calls to generate this kind of income. I think it works really well for me. But of course, not everything is good about this strategy because, for example, if you were to sell cash or rather covered calls of Nvidia in this case, I would have missed out some of the gains. So you can see, for example, this covered call on Nvidia at 149, and also earlier I have a covered call of Nvidia at 133. It got assigned. So meaning to say that Nvidia's current price of 164, I have actually missed out quite a lot of gains on Nvidia because my Nvidia shares were caught away. So one can mitigate this downside by just buying back 100 shares of Nvidia once you get assigned. You are required to sell 100 shares of Nvidia, right? One can mitigate this risk by buying back the shares immediately to claim back the ownership of the shares in order to participate in the upside. You can do that. For me, I did not do that because I do not know whether the share price of Nvidia will go up or go down. So everything is on hindsight. I only know that Nvidia shares went up now, but previously at that point in time, I do not know. So I'm actually okay to let go Nvidia shares at that uh assigned price because anyway, I don't mind selling at that price at that point of time as well. Yep, so I hope this video explains the covered calls and the cash secured puts in a clear and precise manner. I think this is a very good strategy. If you guys are interested to find out more, there are much more YouTube resources available. I highly encourage you guys to check it out. And remember, everything I share here is not financial advice, it's only for educational purposes only. Always be careful and also exercise your own due diligence before engaging the markets. And with that, I'll end off this video and I'll see you guys in the next one. Thank you.